If you want to know when when Wall Street is actually going to trigger the next massive Bitcoin rally, you honestly shouldn't be looking at trading desks in New York
Right.
or, hedge funds in London either. You should actually be looking at someone buying groceries in Caracas, Venezuela.
Yeah, I know it sounds completely counterintuitive, but if you don't understand the local dialect of how digital money moves on the ground in emerging markets,
Yeah,
you're
you're flying blind.
exactly, you are completely misreading the global trading signals that are flashing on your screens right now. Like, you're looking at the data, sure, but you are entirely missing the plot.
Right. Well, welcome to this deep dive. Today, we have a really fascinating mission for you. We are going to be decoding the hidden language of liquidity.
Oh, I love that phrasing.
Yeah, it's cool, right? We've got our hands on this brilliant analytical breakdown of Tether, USDT.
Which is the largest stablecoin in the crypto market, by the way.
Yeah.
Massive market cap.
Exactly, and we're exploring how this one specific asset lives this wild double life across Latin America, and, how understanding that dual role is basically the ultimate cheat code for reading broader crypto market sentiment.
Yeah, because, what's fascinating here is that analysts usually fall into this trap. When they analyze crypto markets, they just stare at Bitcoin
All
charts.
right, all day long.
Yeah, and they try to predict the future based purely on past price action. But this source material, it forces us to look under the hood.
Which is so much more valuable.
It really is. It forces us to look at the plumbing of the financial system, specifically these stablecoins that provide the actual liquidity people use to buy the volatile stuff.
Okay, let's unpack this. We have this analysis showing USDT usage and its direct correlation to Bitcoin and Ethereum price action. But what's wild is it explicitly bypasses traditional financial hubs.
Yeah, totally ignores them.
The data doesn't start on Wall Street. It starts by comparing places like Argentina and Venezuela against places like Uruguay.
And that's the key, right? Because we aren't just looking at abstract numbers on a screen or, high-frequency trading algorithms. We are tracking the actual physical flow of human capital.
Real people making real decisions.
Yes. Our core goal today is to connect the dots between the very real, on-the-ground economic realities in Latin America and the high-level technical charts that global traders use to predict these massive market rallies.
Okay, so to understand how USDT acts as a trading signal for a macro analyst, I think we first have to understand why everyday people are holding it in the first place, right?
Exactly. You have to ask why.
And according to our sources, the motivation for holding Tether changes drastically depending on your zip code.
Complete.
The analysis draws a very sharp line between two different types of demand, right? Structural demand and functional usage. Let's start with structural, because the sources specifically highlight Argentina and Venezuela for this.
Yeah, so think about high inflation environments with just like extreme exchange rate instability. Let's make this really concrete for a second. Imagine you run a small bakery in Caracas.
Right.
If you sell your bread for local currency in the morning, by the afternoon, the purchasing power of that money might have dropped so significantly that you literally can't afford to buy flour for the next day.
Oh, wow. So the local fiat currency is essentially just evaporating right in your hands.
It's evaporating, exactly.
Yeah.
So because of that harsh reality, an average citizen in Venezuela isn't holding Tether because they're, waiting to day trade Ethereum.
Right, they're not speculating on some random altcoin.
Yeah, not at all. They are holding Tether as a direct substitute for the physical U.S. dollar. The demand for stablecoins there is entirely structural. It's baked into their daily economic survival.
Just baseline survival.
Yeah. They use local peer-to-peer networks to swap their depreciating local currency for digital dollars just to preserve whatever baseline wealth they have.
So in those economies, it sounds like USDT is less of a financial instrument and more of a life raft.
The life raft is the perfect way to put it.
Because if your ship, meaning the local currency, is sinking, you aren't grabbing a life raft because you want to trade it for a jet ski later.
Right.
You are grabbing it so you don't drown.
You're just trying to stay above water. And the financial metrics actually reflect that survival instinct perfectly.
How so?
Well, the analysis points out that this structural demand results in persistently high trading volumes and significantly wider spreads in those local markets.
Okay, wait. The source mentions those wider spreads as a key indicator of structural demand. Can you break down the mechanics of that for the listener? Why does a desperation to hold digital dollars translate to a wider gap between buy and sell prices?
Yeah, of course. So a spread is simply the difference between what a buyer is willing to pay for an asset and what a seller is willing to accept.
Right. Pretty standard stuff.
Right. But when demand is structural, when you desperately need that digital dollar just to buy groceries next week because your local fiat is collapsing, the sellers know you are a captive
Oh,
audience.
man. So they know you have no choice.
Exactly. You don't have the luxury of waiting around for a better price.
Right.
So the market makers, the people facilitating these local trades, they demand a premium for providing that stability.
Because you'll pay it. You have to.
You have to. So the gap between the buy and sell price just widens.
Mm-hmm.
The liquidity is thick, meaning there are lots of transactions happening, but it's expensive.
Got it.
And crucially, that capital doesn't move easily into other crypto assets. It just stays parked in Tether.
Right. Because you don't gamble with your life raft.
Exactly.
But the source material contrasts this heavily with Uruguay, which presents a completely different economic landscape,
That's
right?
night and day.
Because Uruguay has a stable macroeconomic environment, relatively low inflation,
Yeah.
and a robust functioning banking sector.
Yeah, and that underlying stability removes the structural desperation entirely. The need for a digital life raft virtually disappears in Uruguay.
So what are they using it for then?
Well, there, USDT becomes a functional tool. It operates as a bridge.
A bridge, okay.
Yeah, it allows local capital to easily operate on international crypto exchanges, or it allows freelance workers to receive cross-border payments without dealing with all those sluggish, really expensive legacy banking rails.
Okay, so they aren't using it as a shield against their national currency. They are using it as a high-speed vehicle for global finance.
Precisely.
But wait, if I'm a global analyst trying to read market sentiment, this presents a really interesting data challenge, doesn't it?
Oh, a massive one.
Because, I mean, I know that in Argentina, USDT is a life raft, meaning that money is basically parked there indefinitely just to survive inflation.
Right.
But in Uruguay, USDT is just a ferry ticket. It's a functional bridge to go buy other things or move capital around.
Yeah.
So does analyzing Uruguay's liquidity flow give us a much purer, more accurate look at global trader sentiment than looking at Argentina?
Yes. That is the critical insight from the source material. If you just look at the total aggregate demand for Tether across all of Latin America as one big block.
Which I assume a lot of analysts do.
They do. And the data becomes incredibly noisy.
Yeah.
It is heavily polluted by the survival mechanics of Argentina and Venezuela. If you blur them all together, you are fundamentally mispricing the amount of sideline capital that is actually available to enter the broader crypto market.
Wow. Okay, but how does an analyst actually separate that data, though?
It's tricky.
Like if I'm sitting at a Bloomberg terminal or running some on-chain analytics firm, how do I isolate a clean signal from Uruguay versus the noisy survival data from Venezuela? Are they just looking at regional IP addresses?
Geolocation definitely plays a part, but it's much more sophisticated than that. Analysts actually look at the specific type of exchanges where the volume is happening.
Oh, okay.
Yeah, so in places with high structural demand like Venezuela, a massive portion of the volume happens on peer-to-peer or P2P networks.
The local networks.
Right, these are localized platforms where individuals are directly swapping local bank transfers for Tether with each other. But in Uruguay, the volume profile looks entirely different. Analysts will look at the flow of funds to centralized global exchanges, like the massive international platforms originating from that region. By filtering out those hyper-localized P2P networks, analysts can basically strip away the structural, survival-driven liquidity and just isolate the functional, trading-driven liquidity.
That makes so much sense because if a user in Uruguay is holding Tether on a global exchange, they are making an active choice to hold it.
Exactly.
It's not a forced survival decision. They're waiting for an opportunity. And I think that transitions us perfectly from the local Latin American usage to the global macroeconomic stage.
Right, the big picture.
Yeah, because those active choices roll up into one of the most important technical indicators in all of cryptocurrency, which is USDT dominance.
Yeah, USDT dominance is huge. It's a metric that measures the total market capitalization of Tether relative to the total market capitalization of the entire cryptocurrency market.
Right, so what percentage of the whole pie is Tether?
Exactly. But to truly understand its value, we need to think about it in terms of liquidity velocity, not just static market share.
Okay, let's elevate this beyond the standard definitions you'd hear on regular financial news. Let's look at the mechanics of what this metric actually represents regarding market psychology.
Okay, so think of the crypto market like a massive global casino.
Okay, I'm with you.
USDT dominance isn't just a measure of how big Tether is, it's a measure of action. The tether represents the stack of chips sitting safely in the tray in front of the gambler.
Oh, I like this.
Right. And Bitcoin, Ethereum, and all the various altcoins are the chips actively placed on the roulette table or the blackjack felt. They're exposed to risk.
So USDT dominance measures exactly how much money is sitting safely in the trays versus how much is actively being gambled on the table.
Exactly.
So when that dominance rises, the source calls this a defensive or risk-off posture, meaning traders are pulling their chips off the table.
Yes. They're selling their volatile assets and parking that capital back in the trade. They are accumulating liquidity.
They're retreating to the sidelines.
Right. They're essentially signaling that the broader market is just too uncertain. Like maybe geopolitical tensions are high or interest rate decisions are looming.
So they want to hold dollars to avoid the volatility.
Exactly. But they want to keep those dollars on the exchange. They want to keep them in the casino so they are ready to deploy the second the odds look favorable again.
So it's like traders collectively taking a deep breath and holding it. They are waiting for market confirmation before risking their exposure.
That's a great way to visualize it.
But then we have the flip side. When USDT dominance starts to fall, we get the exhale. Capital leaves the safe harbor.
Yes, and this is the ultimate leading indicator. When dominance drops, it means traders are actively exchanging their tether for risk assets.
They are taking the chips out of the tray and pushing them onto the table.
Push them right into the middle. According to the analysis, a sustained drop in USDT dominance is often the earliest signal of an upside breakout.
The very first clue.
Yeah. It's that moment of finally jumping into the pool after, dipping a toe in for 20 minutes. The hesitation is gone, and the capital is fully committed to growth.
Which brings us right back to our Latin American data challenge.
Right.
Because in a stable market like Uruguay, if we see local exchange data showing a drop in tether holdings, that is a pure signal of capital flowing into risk. We can trust that signal.
We can trust it completely.
But in Argentina or Venezuela, a persistently high tether holding isn't a risk-off trading posture indicating fear of the crypto market.
Not at all.
It's just their baseline structural reality indicating fear of their own local government's monetary policy.
Exactly. You have to know the dialect to read the sign. This signal in Uruguay is driven by global risk appetite. The signal in Argentina is driven by local economic necessity.
So if you don't filter out the noise?
If you don't filter it out, you will look at the global data, you'll see massive tether holdings, and you'll assume the market is terrified and bearish.
When in reality, a huge chunk of that tether is literally just paying for groceries in Caracas.
Exactly. It's not sideline capital waiting to buy Bitcoin. It's capital that's never going to buy Bitcoin.
Wow. Okay, so let's take this psychology of liquidity flows and apply it to actual price action, because understanding the behavioral theory is great, but you and I know the listener wants to know how to spot the rally before it happens.
Oh, for sure.
And the source analysis gives us a really specific formula for this. It warns against a trap that novice traders fall into constantly, which is looking exclusively at the price line going up and just assuming a bull market has begun.
Yeah, that's the oldest trap in the book. If you only look at price, you will inevitably get caught in false breakouts. Institutional traders call these bull traps or liquidity grabs.
They can be brutal.
They are. The formula from the source material requires you to look at three things simultaneously. You can't just look at one. You need the price, the trading volume of BTC and ETH, and the USDT dominance.
Okay. And the source material actually gives us hard numbers to watch for a breakout, specifically resistance levels of $72,265 for Bitcoin and $2,180 for Ethereum.
Very specific levels.
Yeah. But before we talk about why hitting those numbers isn't enough on its own, let's establish what a resistance level actually is in the context of market mechanics, just so we're all on the same page.
Sure. So think of a resistance level as a psychological and mechanical glass ceiling.
Okay.
It's a specific price point where, historically, a massive amount of selling pressure exists. There are literally billions of dollars in automated sell orders sitting on exchange order books at or near that exact decimal point.
Wow. Billions.
Billions. Every time the price approaches that number, traders who bought in earlier decide to take their profits. Or people who bought at the top previously, they just decide to break even and get out.
Right. They just want their money back.
Exactly.
Yeah.
So the market floods with sell orders, pushing the price back down. Breaking through a resistance level requires an overwhelming, sustained amount of buying power to chew through all those accumulated sell orders.
So if I open my phone and I see Bitcoin inch past $72,266, the natural instinct is to celebrate and assume the glass ceiling is shattered forever.
Oh, absolutely. Everyone wants to celebrate.
But the text explicitly warns against this instinct. Why is the price alone a trap?
Because a price can temporarily spike past resistance on really low trading volume, or maybe just due to a few isolated massive buy orders from institutional whales.
Oh, I see.
Yeah, so that isn't a true breakout, it's an anomaly. The combined signal identified in the text is this. The probability of a massive sustained rally increases exponentially only if Bitcoin breaks $72,265 and Ethereum breaks $2,180.
Both of them.
Both of them. While simultaneously, USDT dominance is actively losing market share.
Okay, let me visualize this for you, the listener. Think of it like a playground seesaw.
Oh, a seesaw.
Yeah. If you want the Bitcoin side of the seesaw to go way up and stay up, you physically need the heavy weight of Tether to be coming down on the other side.
Yes.
A breakout isn't just a magic number flashing on a chart. It's a massive transfer of kinetic energy. It's confirming that liquidity is actually bleeding out of the stablecoin to fuel that rise. Exactly. The liquidity is the fuel. If Bitcoin hits that $72,265 mark, but USDT dominance isn't dropping, meaning Tether's slice of the overall market capital is staying the exact same or even growing, that tells you the rally lacks the fundamental fuel to sustain itself.
The seesaw is broken.
Yeah.
It is a phantom pump.
It's a total phantom pump. It means the upward move is incredibly fragile. Without the corresponding drop in USDT dominance, there isn't a broad market-wide deployment of capital.
The chips aren't moving.
Right. The chips aren't actually moving from the trays to the table in a meaningful way. And the moment those few large buyers stop propping up the price, it will crash right back down through that glass ceiling, trapping literally everyone who bought the top.
Wow. This really transforms a chaotic, seemingly random market into a measurable system of cause and effect.
It does.
We are pulling all these threads together to realize that analyzing crypto is basically an exercise in behavioral economics played out on a global scale.
Totally. And let's sort of synthesize this journey we've just been on because we covered a lot of ground.
Yeah, let's recap it.
We started by looking at a single asset, Tether, and discovered it essentially lives two completely different lives depending on the local economic reality.
Right.
In high inflation, unstable economies like Argentina and Venezuela, it acts as a structural survival tool. It's a digital life raft against collapsing fiat currencies.
And because of that structural necessity, its demand there is sticky and expensive, creating massive noise in the global data. We have to filter out those localized P2P networks to find the true signal.
Exactly. Then we looked at stable economies like Uruguay, where Tether is a functional bridge. It's a ferry ticket to global trading on centralized exchanges.
Right.
By isolating that functional usage, we found the pure signal for global market sentiment, which led us straight to the concept of USDT dominance.
The ultimate measure of the market's defensive posture, our casino tray. Rising dominance means hoarding the fuel. Falling dominance means burning the fuel and committing to risk.
Yes. And finally, we combine that fuel gauge with these specific engine RPMs. So, Bitcoin breaking the historical selling pressure at $72,265 and Ethereum at $2,180.
The glass ceilings.
Right. If the price breaks the glass ceiling and the dominance drops simultaneously, the seesaw tips, and you have your confirmed fully fueled breakout.
So if you're listening to this and you're looking at your own portfolio, you might be wondering why you should care about a stablecoin you might not even hold.
Yeah, that's a fair question.
But the real takeaway here isn't just memorizing a pair of resistance numbers, right? Prices change. Resistance levels will eventually be broken, left behind, and redrawn at new heights.
Always.
The real value is adopting this framework of thinking. It's learning to think like a true macro analyst.
Exactly. Looking past the flashing green and red numbers to understand the physical mechanics underneath, it's about following the actual flows of liquidity rather than just reacting to price changes.
It's the why.
Yes, it's asking yourself, who is holding this money, where do they live, and why do they need it right now? Because once you understand the why behind the liquidity, the what of the price action becomes a whole lot easier to predict.
Definitely. And as we wrap this up, there's one final, really lingering thought from the source material that I want to leave you with to mull over on your own.
Well, this part is fascinating.
It really is. Think about the macro trends outside of crypto right now. We are seeing global macroeconomic instability rising in real time.
Everywhere you look.
Supply chain shocks, geopolitical tensions, shifting monetary policies. What happens if more countries start looking like Venezuela or Argentina economically?
Right. What if the local dialect of survival spreads?
Exactly. If more nations develop a desperate structural survival demand for USDT as a daily life raft, won't that permanently inflate the base level of USDT
It's
dominance?
a staggering question.
Isn't it?
Yeah, because if half the world needs Tether just to buy groceries, the total market cap of stablecoins will skyrocket. Not because of global traders hiding their chips from risk, but because of everyday people hiding their life savings from inflation.
And if that happens, if structural demand vastly overshadows functional trading demand on a massive global scale, could the traditional technical charts that global traders rely on to predict Bitcoin rallies eventually just stop working?
It's entirely possible.
If the seesaw gets permanently weighted down on the tether side by global inflation, how will we ever read the hidden language of liquidity again?
Honestly, we might have to learn an entirely new language.
Something to think about the next time you look at a chart. Thanks for joining us on this deep dive into the hidden language of liquidity. Keep questioning the data, and we'll see you next time.